I'm going to kick off before I hand over to the wonderful Julie Mentor. But to begin, I'm Erin Sahan. I work at Doughnut Economics Action Lab. I lead our work on taking Doughnut Economics into the world of business. What's really critical in that work is two things. Firstly, this happens through a community of practice, of organizations, of people, of consultants, of various startup incubators, of business networks, all kinds of organizations that are values aligned, that want to take Doughnut Economics into the world of business and into other themes. So I'm going to give a brief description of that before I hand over to Julie. Secondly, it happens through a focus on something that we call the deep design of business. And the deep design of business is about the concept that we have borrowed from and worked with Marjorie Kelly on around enterprise design being the purpose, the networks, the governance, the ownership, the finance of a business. Ownership design is central to all of this. It encompasses the word ownership, but it certainly covers governance rights, it covers the financing arrangements, it covers how purpose and various stakeholders in the networks are part of the design of the company. So while this is about alternative ownership models, it is also much broader. It is about the deep design of business. Now, when we do our work on taking Doughnut Economics into the world of business in this way, I hear one thing again and again from those people that are using Doughnut Economics tools with businesses, which is, hey, to question the deep design of business, we need to learn how to engage with the world of finance. We need to learn how to engage with investors, with others who can help fund and finance the enterprises and their amazing work. This has become really quite a central question that is coming up again and again. And we collaborated with Transform Finance in the work that they drove, they delivered, and they were in depth on around how can they look into ownership models that can facilitate these sorts of transformations in our economy, and how can we engage the investor world in that journey. So Julie's going to present on all that, and that's available on the website of Transform Finance. And a quick just demonstration of the deal website as well, to quickly show you where everything lives for those that are new to the Doughnut Economics Action Lab community. We have a community section here, and we have organizations in action. And these organizations are registered from around the world. These are values-aligned organizations who are doing Doughnut Economics in their communities with different sorts of change makers. So for instance, Transform Finance is here, and if you can click in to see more about Transform Finance, but we have over 100 others as well based around the world that are taking Doughnut Economics into action. So if you're interested in using the tools of Doughnut Economics, please do register here. There's a submit an application section. And if you're interested in the tools that we're talking about, that Julie's work builds on, if you go to business and enterprise page, you can go in here, look at the tools that we have created. These are in the Creative Commons, therefore registered organizations to use with their clients and with their members and with broader communities. But you can sort of go into the slide deck, look at all the materials, all the canvases, and this is just a guided workshop to go through the process of Doughnut Economics. I'm going to pause there now, and I'm going to hand over to the wonderful Julie, who is the programs director at Transform Finance. She's worked across the world of investment and management consulting and strategy. She's been the managing director of an impact first venture fund. So she knows that internal mechanics of the investment and finance world. She's also worked at BCG and has been involved in a whole host of models of change making since. So Julie's one of the people I trust inherently to guide us on that journey. And Julie, the floor is yours.
Oh, thank you so much, Erin. Very kind. I'm gonna get my slides up. And yeah, so pleased to be here. So pleased to be in partnership with you, Erin, and the Doughnut Economic Action Lab community. Erin has been a really close thought partner on all this work over the past year and a half and even before that. So really excited to be here. I will essentially in this conversation or in this presentation and then conversation, we'll tell you a little bit more about alternative ownership enterprises, which is kind of the term we use for companies that are really rethinking the ownership layer of their organization, and then talk about the investor perspective. So how investors are coming to this work, how they're thinking about their role in the ecosystem. Just for context, I'll tell you, just a little bit about Transform Finance. We're a research, education, implementation partner for the movement to transform finance. And really what that means to us is having all of finance follow these principles listed here, that those affected have a chance to design outcomes, govern processes, and share in ownership. So ownership is really, really core. That investors add more value than they extract as returns. That's also known as non-extractive investing. And then that risk and returns are fairly allocated among stakeholders. So it's a lot of the things really that you can get to by changing the structure of ownership. And that is why really our focus currently is mobilizing capital towards alternative ownership enterprises. So what are alternative ownership enterprises? Essentially, the way to think about it is in conventional companies, owners, typically external investors or a small set of people at a company, have two core sets of rights. They have economic rights, so that's the right to financially benefit from the surplus of a company. And then they have governance rights. That's the right to make decisions about the company, elect the board, decide whether to sell the company, those kinds of things. And in contrast, essentially, alternative ownership enterprises are firms that significantly shift those rights, economic value, and decision-making power towards non-external investor stakeholders they impact. That can be workers, producers, consumers, community members, the list goes on. It can even be a non-financial purpose. So that can be the planet. It can be a different kind of, non-human entity. And the way that works is that essentially how this shift happens, it can happen in one of four ways. You can just shift who owns, right? So you can go from it's a small set of external investors who own to a broad base of workers or customers who just own the shares of the company. So that's a cooperative is an example of that. You can also split economic and governance rights into different share classes so that the folks who get to financially benefit and the folks who decide are different. So that can be a golden share model where essentially there's this class of shares that's really focused on the governance, something Tony Chocolonely did recently, for example. Another way to do it is you can provide rights to non-owners. So a trust that owns the company can formally delegate governance rights to employee and employee ownership trusts. And then the last one is you can create a formal legal structure that limits the rights of owners. And so a benefit corporation might be an example there where the board is mandated to consider purpose in addition to shareholder returns. So there's a number of different ways to get at this core idea of essentially shifting who benefits and who decides. Our work, which is really focused on the US and the UK, and my apologies in advance. I saw there folks from Brazil, from South Africa, and from France, where I'm from. Actually, I grew up in Bordeaux, so apologies that our work is really US and UK centric, but hopefully some of these ideas are still helpful for your work, and it's definitely an area of promise for us to think about that. Anyways, the caveat just for this presentation. So there's a dozen types of these structures, and they really provide a tangible alternative to conventional enterprises by essentially sharing wealth more equitably, being more democratically governed, and or committed to a mission for the long term. So that's alternative ownership enterprises. And just to go in a little bit more detail here, there's really no one size fits all. And there's essentially a lot of options based on the priorities of the business owner, the stakeholders, potentially the investors. And the way that we like to think about it is like, who is centered in this model? Whose needs are most prioritized? So a set of models really think about centering workers. So that's the blue bubble here at the top. You may have heard, this is employee ownership, essentially, is another way to describe these models. And they range from worker-owned, bakery in your neighborhood to really large companies like the retailer Publix, which is owned by its employees via an ESOP. And then there's other models that are really more designed to center a purpose. So that's the green bubble here. And these models include steward ownership, which I'm sure a lot of you are familiar with, and a few other models. So benefit corporations, which I just mentioned, are kind of a lightweight version. And at the other end of that spectrum, there's perpetual purpose trusts, PPTs, that enshrine a company's mission for the long term, in perpetuity, which is what Patagonia did recently. And then finally, I think folks sometimes forget these models, but actually in the US, at least, they're the most common. It's the models that center other stakeholders. So that's the orange bubble here. And those can be, the other stakeholders can be suppliers, customers, et cetera. Folks who don't directly work at a company, but have a direct relationship with it or are directly impacted by its decisions. And that can be a producer cooperative like Organic Valley, a customer cooperative like the outdoor retailer REI. So that gives you a sense of the models. And obviously, as you see here, some of them overlap, right? Some of them can both center the needs of workers and of purpose, and the purpose of a company, or some of them can, be combinations. So that's kind of what you have laid out here. In addition, kind of it's worth thinking about, for some companies, these models, these kind of like really fundamental shift to the ownership structure of the company can be challenging to execute, at least in the near term. And so there's also a set of essentially more lightweight, what we're calling features, that are worth considering, because they really are on the path to sharing wealth, more in a more equitable manner. Profit sharing, stock-based compensation can be designed in a way that is broad-based and benefits, all the workers at a company, for example. You can also have models that share governing power, even though it may not be in the ownership. It can be kind of designed on top. Obviously, collective bargaining agreements with unions and working in partnership with unions rather than in an adversarial relationship can be a powerful solution. And then thinking about, you may not be able to enshrine the mission of the company, but you can use an asset lock structure to reduce the rest of the company will be sold, essentially. So that's, dual class share structure, poison pills. Those are some models there. So those are, just in the sense of the realm of options, just to give you a sense that there's a lot there, a lot possible. And one way to, it's good to have options. Also, it can get to be too much. So here's a few ways to think about how to compare and how to choose. And really kind of the relative strength and weaknesses of the different models. There's no one perfect model, essentially, is maybe one takeaway. It really depends on kind of the priorities of the company. But the ways to, that we think are important to compare. One is essentially who gets these economic and governance rights. So they can be granted to single stakeholders like workers, or shared across the supply chain. Some models might really emphasize wealth building for workers, for example, while others might really be focused on protecting the governance of a company and kind of these steward models. The second piece is this mission lock. So essentially, once you decide that the company cannot be changed, or it is really hard to change it. And so that can be done by having a company's intellectual property owned by a trust, or having an external steward control a golden share, as I mentioned earlier, to prevent the sale of a company. What's interesting about these locks is essentially they're thinking about not just like now and the workers now or the stakeholders now, but how do we have this structure kind of in perpetuity? And then the last really dimension that from a practical perspective is really important to think about is that some of these models are very new. And there's not a lot of expertise around it yet. There's not a huge ecosystem around it, which means it can be kind of expensive. So perpetual purpose trusts, employee ownership trusts are quite new in the US, and there's a growing field and folks working to grow that field. But that makes it a little more challenging than ESOPs, which have been around for decades, where there's a lot of lawyers, a lot of folks who know how this works. So that's one dimension. The other is that some models really have supportive legislation at their back. In the US, benefit corporations are one, while others not as much. So for example, cooperatives in the US have a harder time, and there's like more legal complexity to navigate. So there's, kind of a number of things to consider. I'll say one last thing just on this kind of quick introduction to the different models, which is we wrote a very long report. And if you really kind of wanted to give you a sense here, but really recommend going to this, and I'll go to the previous slide because the link is there maybe. So just so you see this bit.ly AOE dash or AOE hyphen hub, you can get all of our resources and you'll find this report that basically lists out all of these models in great detail and compares them. There's an extensive comparison section, some beautiful charts. So you can kind of wrap your head around them and get a sense of which ones are of most interest and which ones you kind of want to double click on and get a little bit more information about. So that's, part one of these models, and, want to now shift gears a little bit to talk about how, this is all great, but many companies require external financing. They can't just be self-financed. And so figuring out if you're going to do something that investors are not familiar with, how do you acquire, how do you raise the capital that you need? So I'm sure, everyone's familiar. Companies typically raise equity. It's like shares of the company or debt. And for alternative ownership enterprises, and obviously there's subtleties, right? Like the way a cooperative raises money versus a benefit corporation is quite different. So this is like happy to dive into the detail in the Q&A, but just to give you a sense at a high level of how this works. So one thing that's important to think about is for alternative ownership enterprises, raising kind of common equity is challenging because essentially common equity is structured to give both economic and governance rights together to an external stakeholder. And so in the models in which you want to retain governance rights or you want to share them with, a trust or some other entity, then it becomes challenging. And so preferred equity, which typically has more senior economic rights but no governance rights, is a possibility that some investors are open to. So that's kind of one option. There are models where you can do equity, but not many, so it's just limited there. At the startup stage, we see many companies funded by crowdfunding. So those are more donations or crowd investing, or even by grants for companies that are really kind of mission oriented. But the sums that you can raise in that way are usually smaller, and so it becomes more challenging as the company grows, because usually a company will require larger sums of capital as it grows and evolves. And so but we've seen a lot of really interesting crowd investing solutions, in particular for companies that have a community, are really embedded in their community. So that's an interesting option. And then finally, debt is really possible at any stage. But because it is possible doesn't mean that it happens. Because if you're an early stage startup, finding a bank that's going to loan you money when you're just, an idea can be quite challenging. So it becomes easier essentially at later stages when a company has a financial track record, a demonstrated profitability, or potentially some assets that could serve as collateral. So that's when debt comes into place. And that is why really financing for conversions often is easier than for startups. And so then that's where we're seeing the bulk of the activity, is taking a company that is profitable, has a track record, has, a customer base, has a product. And then as the business owner retires or looks to sell the company, essentially having them sell it to their employees or to a community is a path that can work quite well. So just to say a little bit more about the funding landscape, we just did a survey of all the funds that we could find that invest in this area, either fully or partially, and there's 43 funds. So that was exciting to see. Collectively, those funds kind of have raised or aims to raise about $3 billion. This is really like very approximate math, just to give us an order of magnitude. And so 3 billion can seem like a lot, like it's, that's definitely more money than I can kind of wrap my head around. But on the other hand, it is still quite small. Like just venture capital in the US, for example, is deploying 200 to 250 billion a year in the US. So, this is even smaller than how much money private equity, for example, is deploying. The 15 of these 43 funds are really focused on alternative ownership enterprises specifically, and that is largely either cooperatives or ESOPs. And the bulk of the funding activity, as I said, is focused on conversions, in part because of the track record, and in part because the cost of setting up and running an ESOP, like you don't have a startup ESOP, that doesn't make sense. That's for larger companies. And that is, those tend to be bigger deals. So when we look at kind of the volume, like how much money is being transacted, ESOP conversions tend to be the biggest share there, not necessarily number of companies, but in volume. There are also investors who do direct deals into alternative ownership enterprises. So they're not a fund, they're a pension fund, they're a high net worth individual. That is, a little bit less common, but you may have heard Canada's Healthcare for Ontario pension plan. So this, pension basically was the main funder for the conversion of Taylor guitars, which is now 100% owned by an ESOP. So those models do exist. But for folks who are, you're a business owner and you're looking to, or you support entrepreneurs or business owners, funds can be a really good starting point because they're really focused on they're on providing financing for these kinds of companies. And on our website, again, same kind of bit.ly link that I share, we have the database of funds that we put together is on there, so you can go and see like, which are those funds, who runs them, what's their website, so you can get a sense of who you might want to pitch for funding, or if you're an investor yourself and you're looking to deploy capital, putting money into those funds can be a really effective way to support this ecosystem. So there's a lot happening, and as I mentioned, it's still limited, and in part because investors really perceive this area as risky. Some of it is real risk, and some of it is just this perception of risk. The perception of risk because there's a lack of familiarity. The number of acronyms in this space is high, and that's part of why we're doing this work of demystifying and building familiarity with investors so that they can get more comfortable with what's happening here. Another kind of more real risk is often if you're investing in a company that is shared across multiple stakeholders, there's no personal guarantee. So a lot of the ways small and medium businesses raise money is the business owner will essentially provide a personal guarantee. He'll say like, if I don't pay you back my loan, you can come get my house, which is in and of itself not necessarily something I'd advocate for, but is kind of how a lot of business lending happens. And so if you have 100 workers at a company, the bank's like, well, whose house do I repossess? So that can be a hurdle in terms of current loan practices and lending practices. And then the last one, which is again more in kind of this perception of risk category, is that investors are used to just equity where they have governance and economic rights, and having the conversation of like, well, actually, if you were to relinquish some of your governance rights, workers would feel more empowered and have more incentive to like stick around, and you'd have less churn in your company. They would be more productive. So there's a lot of research that shows that employee-owned companies in particular have higher productivity, higher retention than non-employee-owned companies, but that is just unfamiliar and uncomfortable for some investors. So yeah, I think the top line is this landscape is still limited, but definitely growing much more than it has just even 5 years ago. And one thing I'll say maybe is that because it can be hard to finance these deals, this is why I shared earlier these lightweight features as a way to start. So what we're seeing is some folks really thinking about their stock option pool in very different ways, thinking of your stock option pool less as a like, oh, this is how I retain my senior engineer, and more like actually this option pool is something investors are used to granting. Let's maybe make it a little bit bigger and really allocated in a broad-based way to all employees. So that can be a way to do these kinds of models without having investors even really kind of have it not be that different from an investor perspective. And when I say investor, there's actually it's kind of two categories of investors in this space. There's folks who are invested in this space really for the impact and thinking about the mission and the value for our economy, for our ecosystems of having these alternative structures. And so those investors tend to be foundations, kind of the investment arm of foundations, or even the grant-making arm of foundations, family offices, high net worth individuals, a number of impact first funds and financial institutions. So CDFIs, networks like Seed Commons and others who are really thinking about how do we shift the economy and how it works and who it benefits. So those folks are looking for a wide range of returns. Some folks are comfortable doing grants, doing non-extractive 0%, very, or low interest loans. Others are interested in the impact, but still looking for kind of risk-adjusted returns or market rate. I say it in air quotes because, what even does market rate mean? But that's kind of that set of return expectations. And really their motivation, as I mentioned, is the impact. By and large, we're seeing folks motivated by reducing the wealth gap. Some folks explicitly the racial wealth gap and thinking about racial justice as a lens. But some are more broadly focused on just the solidarity economy and interested in building, networks of relationships in these companies that are governed alternatively. And we also see a potential to connect to other impact areas. So climate justice, education. We're not seeing that as much, but I expect those investors will kind of see how this can be really aligned as a way to deepen their impact. So that's a category of investors. They exist, they're active. And there's a lot of promise there. And it's still, it's a relatively smaller pool of capital than other investors who are really value essentially and see the productivity boost associated with ownership culture or having employees or stakeholders really invested in a company. And or really want to take advantage of the beneficial tax treatment of ESOPs or some of the external stakeholder cooperatives like rural electric co-ops, for example, have access to financing from the federal government, for example. And so for those folks, they're private equity investors, banks, some degree of venture capital. Really, they're looking for a risk-adjusted return, and there is a part of this ecosystem that can definitely be that. They're profitable companies, they're growing, they can take on external debt, pay that back, kind of the same way they would, not necessarily looking for a lower rate of return. So that's giving you a sense, and based on what you're looking to accomplish, really being clear on what kind of investor are you going for and what kind of return. It really matters because you should be talking to a very different set of people, and you don't want to waste your time going after private equity if really you're looking for a low interest loan. So that's the kinds of investors. And then last thing I'll say here, and maybe we can send this in an email afterwards. There's a lot of resources. So I mentioned our fund database and our kind of our resource hub that has the report, a number of other things. The New Economy Coalition is launching a funding library today. So they'll be they're sharing a lot of folks who are funding this sector of the economy, kind of solidarity economy. Village Capital has a really helpful capital explorer tool where based on the stage of the company you're at and all of that, you can get a sense of who might be able to fund. And similarly, the Innovative Finance Playbook has a funding section with a list of funders kind of who are open to doing revenue-based financing and a number of other things. Yeah, so that's it. I see there's a lot of, I saw there's a lot in the chat. I haven't actually read it at this point, but Erin, how about I hand it back to you for what we do next?
Sure, absolutely. And we've got some fantastic questions coming through. I've been sort of giving my 2 cents on a few of them, and we can call on them just after the breakouts. But just firstly, to remind some of the new people who joined, the reason this is a Doughnut Economics Action Lab hosted webinar is because to apply Doughnut Economics, we are talking about putting on the table the really transformative ideas for the business world that are testing the deep design of those businesses, that are often those ideas that are held back by 20th century enterprise design that has put shareholder wealth first, that has been in service of extractive finance, that kind of design of ownership in particular, and the need to transform and evolve that. So this conversation that Julie has led us through is very much at the very heart of Doughnut Economics, and the tools that I pointed to are another way to engage into that, but they don't go into anywhere near the kind of depth that Julie has set out for us here. And the report sets out, it's 190 something pages, by the way. So a lot of fantastic detail in the report. So I'd urge you to look at that and the Learning Hub as well on Transform Finance's website.